Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. One of the companies that's had a really nice run over the last 6 months or so is Opendoor. The company reported better than expected earnings in the second quarter. It looks like margins are pretty strong right now and that may continue throughout the rest of the year. But this is still not a stock that I think is worth buying, but I want to dig into why. My name's Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. And first, I want to show the performance of Opendoor's stock. You can see that if we look just over the last 6 months, the stock has more than doubled in value, $1.34 about 6 months ago, now trading at about $4 per share. But if we pull back, this is a stock that was trading for over $35 per share for a period of time, and really until late in 2021 was over $25 per share. This was a SPAC merger, which started at about $10 per share. So has not really worked out well for investors. And one of the reasons is that the iBuying business has just not been as profitable as a lot of people thought. You can see that in the most recent quarter, the company's revenue is dropping. And this is in part because the amount of volume going through the real estate business is really down right now, and sellers have a lot of options. But the company did make some adjustments to the way that they operate their business, and that is starting to help margins. You can see that this is what they call the old book and the new book. That old book, 3.1% gross profit margin in the most recent quarter, and the new book, 14.4% profit margin. They did say that this is in part because the housing market is a lot stronger than they thought it was going to be. And so that's helping margins in the short term. Remember, this is something that we saw during the pandemic for all of the iBuying companies. Margins were really strong because housing prices kept going up. And I think that's exactly what we're seeing right now. The company has also done a really good job at containing operating costs. This is the operating cost trend from $204 million in Q2 2022 to $78 million in Q2 2023. I love that trend. And if that is something that we knew was sustainable, then that would be a huge positive for Opendoor. But here's the problem. With all of these positives, the company is still expecting to be adjusted EBITDA negative $60 to $70 million in the third quarter. Now, revenue is going to be relatively weak at about $1 billion, and the company is giving out a ton of stock with stock-based compensation of $35 million expected for the quarter. Now, this is the income statement, and you read this from right to left, and you can see that gross margin has been positive the last 3 quarters, but the company does have a lot of operating expenses. And as a result, income from operations has been negative for the last 4 quarters. The only reason there was net income in the most recent quarter was a gain on buying back debt. The problem for Opendoor is the housing market, when it's really strong, sellers don't really need to go to a company like Opendoor. They can go out into the market and find buyers relatively easily. So the houses that Opendoor ends up buying are the ones that aren't selling by themselves. That's why we see the time on market for Opendoor houses is actually relatively high. The company is judging success on housing being on the market for 120 days or less. That's something they reported in the most recent quarterly letter. That is a ton of time for a typical home to be on the market in this market. Now, if the market weakens and values aren't going up, then the people who might be selling to Opendoor are going to be the people who can't naturally sell their houses, but they're selling into a weakening market. That could lead to losses. That's something that we saw with some of these iBuying companies in the last couple of years, was they were buying houses at the peak, and then the market turned and they were trying to sell them at a loss. So the dynamics for Opendoor are just not very strong, and we have not seen this be a consistent money-making company. Now, I love the concept, and I really hope that this works. But right now, we're not seeing the consistent numbers and improvement in the company's financial statements to make this a great investment. This is definitely one I will be watching because I would love those margins to be a little bit more consistent. I would like to see volumes increase. That's the other challenge that they have, is they have to increase volumes and have to have homes going through the system to be able to make money. But if they can't do those things on a consistent basis, this just isn't a business that's going to work. This is why most companies have already exited the iBuying business. Opendoor is one of the few companies left, and it just doesn't look to be very strong at the moment. But what do you think? Do you disagree? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.